Retiring early is a whole different ballgame, not because you are more likely to run out of money. In most cases, I've actually seen those clients of mine who have retired early are some of the most diligent savers and spenders there are. But there are 6 different reasons or decisions that make your retirement different, and you need to plan accordingly. If you're between 50 and 59 and a half with $2 to $5 million saved, your retirement picture is way different from someone who's retiring at age 60 or later. You're too young for Medicare, too young for Social Security, too young to touch most of your retirement accounts without a penalty in most instances. And you're old enough that the decisions you make in the next 12 months will compound for the next 40 years of your actual retirement. I want to go over these 6 decisions that are different for you than those going through a more traditional retirement timeline, those people who are retiring at like 65 or later. These don't necessarily make things harder. They just need to be thought about in a slightly different vein than those who retire on a more standard timeline. And I want you to make sure you stay through the end, because we're going to be walking through a hypothetical case study at different points throughout this video. And this will show you how this actually works in your case. So let's jump into the first decision. The first decision is funding your lifestyle. And we're going to start with this uncomfortable one first, because everything downstream depends on it. Most people blindly follow the 4% rule when it comes to taking their assets out in retirement. The merits of that rule are a discussion for another video and one that we've done in the past, but the idea is that you can retire, invest in a 60-40 portfolio, take out 4% each year and adjust that number for inflation, and you're never going to run out of money. So someone with $3 million the year they retire can take out about $120,000 in year 1, and every year after that is going to be adjusted for inflation. So if inflation is 10%, take out $132,000 the next year, so on and so forth. Here's what I need you to internalize though. The 4% rule was built on a 30-year retirement. Retiring early likely adds at least another decade to that number. When you extend the horizon another 10 years, the sustainable starting withdrawal rate doesn't drift down a little. It compresses hard. Most of the research on multi-decade horizons lands closer to 3.25% to 3.5% as a starting point when you're retiring early, and none of that comes with a guarantee. 3.5% of $3 million is $105,000 a year. And then you're going to adjust for inflation based off of that. That's before you pay taxes and before you factor in your increased healthcare costs, because you're likely facing the ACA marketplace here. So the honest translation is this. Their portfolio supports somewhere in the neighborhood of $100,000 to $110,000 of actual spending before increased healthcare costs. Those healthcare costs, which I will cover later, can eat into 30% of that number for a married couple in the ACA marketplace who's just on a silver plan. Now, I'm not telling you 3.5% is the answer here. I'm telling you that I have $3 million is not a plan. It's an input. The output is a spending number, and the gap between those two is where early retirements can break. There are exactly 4 levers when the math doesn't work. You could spend less, work longer, earn something, or take more risk. That's it. There's not a 5th lever here, and anybody who tells you otherwise is selling you a product. So there's 3 things I want you to actually do. First, build the real number, not the comfortable number. 12 months of actual credit card and bank statements categorized. Then add the things that aren't in there yet. The new roof, the car replacement cycle, the kid's wedding, college, the parent who needs help. Early retirees systematically underestimate lumpy spending because they budget from a working year's baseline where those things got absorbed by cash flow. Second, separate the floor from what your discretionary or your flex budget is. What's the number below which your life materially changes? For most households in this bracket, it's somewhere between 55 and 70% of what you're currently spending. So if you're currently spending $100,000 a year, $55,000 to $70,000 is your floor number. That floor is what has to be bulletproof. It needs to come out every year just for you to survive. Everything above that is a dial you can turn back in a bad market. And I'll come back to why that dial is the most valuable asset you own in a little bit. Third, and finally here, you want to sequence your withdrawal, don't average it. Which account you pull from in which year is worth multiple 6 figures over retirement of this length. And it's completely invisible if you're just looking at a total balance. This all leads me to where you can actually get your money from in retirement before 59 and a half. So your second decision now is how you actually get the money before you're at that magical 59 and a half age where the government no longer penalizes you for taking your own money, which is a stupid rule, but it's what we're working with here. Let's walk through a hypothetical couple, Dan and Rachel. They have $3.1 million. Each has $1 million in their 401k. Rachel has another $300,000 in a Roth IRA, and they have another $800,000 in a brokerage account, of which $550,000 is basis. Dan is 55 years old. If he does the obvious thing and rolls it into an IRA at separation, because that's what the advisor at the bank told him to do and what everybody else does, he's just locked $1 million behind a 10% penalty wall for 5.5 years. There are two doors through that wall. They're very different, and most people pick the wrong one. The first door is the rule of 55. If you separate from service in or after the year you turn 55, you can pull money from your company 401k without a distribution penalty. And this is huge because if you're pulling out like $100,000 you to live on, that's an extra $10,000 that doesn't get taken from you. You still owe ordinary income tax on that number, but the penalty is gone. 4 things that trip people up here, and I want you to write these down. It applies to the plan at the employer you just left. So if Dan was a mechanic at GMC, and that's when he retired, but before that he worked at Ford, his Ford retirement plan no longer matters here. It's just his GMC 401k plan. So it's not old plans from old jobs. It does not apply to IRAs. So if he rolled anything into an IRA, that money's also excluded. If you roll that 401k into an IRA, which is what the rollover paperwork is designed to make you do, the rule of 55 evaporates permanently. This is the single most common self-inflicted wound I see in this age band, and it's something that severely hampers your liquidity in early retirement. And the calendar year here matters a lot, and it's not your birthday. So if you separate from service in January of the year you turn 55, but it doesn't happen until November when you turn 55, you actually still qualify. So don't let somebody say just because you're 54 now and you retired, you won't qualify. You'll just have to wait until after you turn 55 to start taking distributions from that account without the penalty. And critically here, your plan document has to permit something called flexible distributions. A lot of plans only allow a full lump sum or a rigid installment schedule after separation. So read your summary plan description before you resign, not after. Or better yet, hand it to your accountant or your financial planner and have them do it for you. If the plan is inflexible, that changes your entire sequencing strategy. There's one bonus for another plan type. If you have a governmental 457B, there's no age-based distribution penalty at all after you separate. So public sector folks and hospital executives, check for this one. And if you're a qualified public safety employee, your threshold is age 50 rather than 55. The 457 plan is one of the most flexible plans for early retirement. So if you have one, that's just another benefit you have moving into this stage of your life. The second door that most people typically use is a 72T distribution, which is a SEP payment or a substantially equal periodic payment. This is the one people have heard of and shouldn't usually use in early retirement. I'm going to go over how it works, and then later we're going to touch on why you should not use this unless you have to in early retirement. A 72T plan technically is a series of substantially equal periodic payments, and it lets you take penalty-free distributions from your IRA before you turn 59 and a half if you commit to a fixed calculated payment for the longer of 5 years or until you hit 59 and a half. So if you retire at 52, your window's 7 years. If you retire at age, 58, you still have to do this for 5 years because it's the longer of the windows. The IRS has 3 different approved calculation methods. There's the RMD method, the fixed amortization method, and the fixed annuitization method. And I'm happy to chat with you outside of this video to talk about what each of these options provide in income. But for simplicity, the RMD method is age-based and is very similar to when RMDs start at age 73 or 75 for people who are of full retirement age and need to start taking that money out later on. The other 2 methods are fixed amounts that are based on a distribution percentage that is typically larger than the RMD method. And just to ballpark these numbers, a 50-year-old running a fixed amortization on a $1 million IRA can generate roughly $60,000 a year. And remember, that's fixed. Whether you need it or not, you have to take $60,000 a year out while you're within that 5-year or longer window. And the RMD method on the same account produces closer to $28,000 for that same 50-year-old with $1 million. So that's two very different withdrawals on the same dollar amounts. Now, here's why I'm not so hot on this for this audience. The penalty for getting it wrong is brutal. If you modify the payments, you take $1 more, take $1 less, roll money in or roll money out, the 10% penalty gets applied retroactively to every distribution you've taken plus interest. At 50, you're signing up for 9.5 years of perfect compliance, and it fights everything else in this video. A locked distribution schedule collides with ACA income management, which is one of the biggest hurdles for early retirees. It also collides with Roth conversion planning. It removes exactly the flexibility that makes an early retirement survivable. So if your money is trapped in IRAs and you have no other liquidity options, the 72T is a legitimate tool. And we have calculated this for clients who use them. But if you have a taxable brokerage account and a 401k with the Rule of 55 access, using the 72T distributions is usually solving a problem you don't have, and you're just creating more complexity than you need. So I want to talk to you about health insurance now, because this is the biggest variable and often the largest expense in early retirement. And this leads us to decision number 3, health insurance, and why this has changed specifically this year in 2026 compared to what we've been dealing with in the past. This section would have been a completely different segment 18 months ago. From 2021 until 2025, enhanced premium tax credits capped what anybody paid for a benchmark silver plan at 8.5% of income, no matter how high your income went. Those enhancements expired in December 31st of 2025, and Congress didn't extend them with the One Big Beautiful Bill last year, which means the subsidy cliff is back. For 2026 coverage, premium tax credits cut off completely at 400% of the federal poverty level. For a 2-person household in the lower 48, that line is approximately $84,600. $1 over, even 1 penny over, not a percent, just 1 penny. And your subsidy goes to zero for the entire year, meaning the government doesn't help pick up any of your cost. And if you took advanced credits during the year and then landed over the line, you repay them at tax time, which could be a tax bomb upwards of $20,000. Below that line, the help is also thinner than it was before. The percentage of income you're expected to contribute went up at every tier. The practical impact on a couple in their 50s is severe because marketplace premiums are age-rated. Unsubsidized coverage for a couple in their late 50s can run $2,000 a month or more, depending on your rating area and what plan you choose. For Dan and Rachel from a few minutes ago, that's the difference between a manageable line item and something that consumes 15% of their gross withdrawal rate, assuming they take out about $100,000 a year. So here's the strategic question, and this is where I earn my keep. Should a household with $3 million deliberately suppress income below $84,600 to capture the subsidy? Generally speaking, yes, but it depends on income needs, size of the pre-tax balances, and what RMDs look like down the line if you do nothing. The years between retirement and age 73 are the widest tax planning window you will ever have. You have no W-2 or 1099, there's no Social Security yet, and RMDs haven't happened yet unless you're doing that 72T distribution. At Nav Wealth Partners, we call this window the Roth conversion corridor. And for someone retiring at 54, it's over 20 years long. That's over 2 decades of systematically moving money out of a $2 million pre-tax account at 12%, 22%, heck, even sometimes as low as 10%, instead of letting it come out at 24% or higher once the RMDs and Social Security stack on top of each other later on. Every year you hold income under that $84,600 to protect a subsidy is a year you don't convert. I actually want to go over a brief example of how this works because it's very important. So I'm going to share my screen for a few minutes and walk you through the intricacies of the subsidy cliff. So let's jump into it. The idea here is that working on either side of the band or on one end of the spectrum or the complete opposite end of the spectrum is typically inefficient. This is a point in retirement planning where blending the two typically makes a lot of sense. So just keep that in mind as we're going through the edge cases and then what we're actually going to recommend for Dan and Rachel here in this instance. Okay, so the first thing you're going to want to do here, and there's a link for this in the description of this video, is you're going to want to check out the RMD time bomb calculator. So what we're going to do is we're going to run this through for our couple here, and we're going to plug in their numbers. And this is the starting point. This is going to tell us that if they optimize for ACA subsidies, keep their modified adjusted gross income as low as possible, do nothing in the way of Roth conversions for the next 10 years or so, what their RMD will look like the first year that they have to take it, which for them is going to be age 75, because they were born after 1960. So we're going to click in here, and what you'll have to do if you're logging in for the first time is you're going to want to plug in your email address, name, and hit sign up here at the bottom. So I'll just do it right here so you can kind of see the workflow. And this will give you access to the tool. So what we're going to do here is first you want to enter in the pre-tax balances. So we know for our couple, they have $2 million in pre-tax balances. That's in their 401ks. They don't have anything in their IRAs yet, no SEPs or simples, and there's no other pre-tax retirement accounts that they need to be aware of. So we know that they were born in 1971 because they're both 55 years old, and they plan to retire at 55. So what we're going to want to do next is we're going to want to plug in a growth rate. So we'll plug in 6% just to be, on the safer side here. Maybe they're not taking too much risk. And what we're going to do is we're going to scroll down a little bit. And at the end of step 2 here is we're going to see their projected pre-tax balance at age 75. So this assumes no money's been taken out from here. And it also assumes that that they're earning that 6% rate of return. So no Roth conversions are done either here. So their estimated annual required distribution at age 75 is $260,000. At 77, we ballpark it to be closer to $315,000, and they make it all the way to age 82. It's about $500,000 a year. So what you'll see here is what you want to plug in next is how they file their taxes. So their annual RMD is going to pre-fill from this age 75 number up here. What we can do is we'll say both spouses in this instance are over 65. Let's just assume that they have $50,000 in Social Security benefits between the two of them, and that might seem low, but I would argue that it's probably right on target because remember, they retired a few years earlier than most people, so their benefits should trend a little bit lower. Let's assume that you get another $10,000 in investment income from that brokerage account and no pensions or other taxable income outside of that. So when you add up their income stack that first year of retirement, it's $313,243 of adjusted gross income. You take from that the standard deduction. If you itemize and your itemized deductions are higher than this, you can plug that number in there. But your taxable income or what they're taxed on is what's going to show their tax rate. So here you have a nice breakdown. So they're completely filling up the 10% bracket, completely filling up the 12%, completely filling up the 22%, and now here they are at the 24% tax bracket. So you'll notice here, though, that if they do nothing, they hit the 32% bracket a little bit later on in retirement when they go over $500,000 at age 82. So they're actually they're actually going into the 35% bracket there as well as they continue to move towards their retirement. So this is the first step. This is the basis of comparison. This is just saying we optimize for ACA subsidies. Where are we going to be when we have to start taking RMDs? So we know the first year they're going to be in the 24% bracket. That's going to fill up relatively quickly, and they're going to find themselves in that 32% bracket and then potentially even the 35% bracket for the majority of their retirement. And this is where we're going to start the other part of the analysis.
But even before you do all that, I need you to check the other 4 doors before you assume the ACA marketplace is your answer. COBRA gets you 18 months at the full unsubsidized group rate plus 2%. It is expensive, but often a better network, and it's frequently the right bridge for someone retiring at 58 who only needs to reach Medicare. Next is a spouse's plan. If, in Dan and Rachel's case, Rachel keeps working part-time somewhere with benefits, that's a $26,000 a year decision disguised as a lifestyle question. There's also part-time or consulting work at an employer that offers coverage. I've seen people take a 20-hour-a-week role that's way less stressful than what they were doing before, purely for the health plan, and come out ahead by 6 figures over a decade. You can also utilize your HSA. You can't contribute unless you're on a qualifying high-deductible plan, but you can pay COBRA premiums from an HSA tax-free. That's a specific exemption worth knowing. You generally, though, cannot use it for marketplace premiums before you turn 65. So just keep that in mind if you're going through the marketplace. There is one caution here, and I want you to be careful with healthcare sharing ministries. They're becoming more popular over the last few years, but they're not insurance. They're not regulated as insurance, and they have no legal obligation to pay your claim. I've heard stories where that's gone badly, so just something to watch out if that's something you're looking into. The next decision you want to make is the risk paradox. And all the risk paradox is how much risk you can take in early retirement. A 40-year retirement requires growth. Inflation at 3%, which is currently where we're at, cuts your purchasing power roughly in half over 24 years. That's about 60% of your retirement if it lasts 40 years. A conservative portfolio may not protect you over that horizon. So you do need equity exposure, meaningful equity exposure for decades. But the first 5 to 10 years of withdrawals are often when sequence of returns risk hits the hardest and does the most damage. Selling shares into a drawdown to fund your grocery bill permanently impairs the portfolio in a way that no subsequent recovery fully repairs. And the longer the time horizon, or the longer your retirement in this instance, the more that effect is amplified. So 2 retirements with identical average returns in different return order, though, produce completely different outcomes when you're withdrawing. So you need growth and you can't afford volatility. That's the paradox, and it's real. Here's how we actually resolve it here at Nav Wealth, and it's not the answer you're expecting. The variable that determines how much risk you can take isn't your risk tolerance. So it's not that shiny number that somebody said, oh, you're a score of 75 on your risk tolerance and therefore you're a growth investor. It's actually your withdrawal rate. And what that withdrawal rate actually provides is just an income number. And that income number is what is leaving your account every year so you can meet your needs. I typically like holding 3 to 5 years of income, of that income number, laddered in cash, CDs, and bonds. So I know 2 things. First, I have a safer bucket to pull from for immediate liquidity. Second is if the market does pull back, I have some built-in time for it to bounce back because of that conservative sleeve. If you're on the more aggressive end of risk tolerance, you want to opt for fewer years spending needs in the conservative sleeve. And if you're more conservative of an investor overall, you want to opt for more in that conservative sleeve. There's 3 structural moves in order of importance that I want you to follow here. Spending flexibility is worth more than any allocation decision that you'll make. A household that can cut 15% in a bad year, whether it's from pausing travel, delaying the next vehicle purchase, or deferring a renovation, can support a meaningfully higher equity exposure at a higher starting withdrawal rate than a household with the same portfolio and a rigid budget. That just means that their fixed expenses are higher. And those are the real risk. Look hard at your debt, at the boat payment, at the second property, even the mortgage on the first property. Every fixed obligation you eliminate before you retire buys you permission to own more equities. Build a defined cash and short duration bond runway. 3 to 5 years of net spending needs held outside of your equities is one thing. Allocating it is completely different. Ladder in the correct amount of cash equivalents in bonds so that your duration matches your spending to lower your risk even more. Then finally, you want to let the rest run. With a funded floor and a cash runway, the growth portion of your portfolio is genuinely long-term money and can be invested that way. And put it in the right accounts. The highest growth assets belonged in Roth, where 40 years of appreciation comes out tax-free, not in the pre-tax account where it becomes an RMD problem for you when you turn 75 years old. That leads us to the 5th decision, and that's when to take Social Security. For Dan and Rachel here, that's decided at age 55. So it's not something that we're going to decide when it gets here. It's something that we actually want to know when we're going to take it going into early retirement. You're not claiming it for years, but you still have to decide it now because the answer changes everything upstream. 4 things that matter for early retirees specifically. Your benefit is based on your highest 35 years of indexed earnings. If you retire at 54, with 31 years of work, you likely have 4 years of zeros that can drag your calculation down a bit. For most high earners, the marginal year is worth less than they fear. You're replacing a low earning year from your 20s, not adding to your peak. But if you have real gaps, like maybe you took some time off for work to raise the kids, or maybe you took a work sabbatical, You want to make sure you pull your Social Security statement and run the actual numbers rather than just guessing. Sometimes one more year of work is worth far more than the salary. It just depends. Full retirement age is 67 if you were born in 1960 or later. Claim at 62 and you take a permanent 30% reduction. Delay past 67 and you earn about 8% a year of delayed credits up to age 70. It is an inflation-adjusted, government-backed 8%, which does not exist anywhere else in your portfolio. For a married couple, this is not one decision, it's two. The higher earner's claiming age sets the survivor benefit for whichever spouse lives longer. When the first spouse passes, the household drops to the larger of the two benefits and the survivor starts filing as a single filer. There's narrower brackets at that point and lower IRMA thresholds on roughly the same exact expenses and nearly the same distributions. Delaying the higher earner's benefit to 70 is the cheapest longevity and widow risk insurance available. The lower earner's claiming decision is a much smaller cash flow question and can often be taken early. And here's the part that connects everything back to everything else. Deferring Social Security to 70 means a bigger gap you have to fund from the portfolio, which looks like a cost and is actually the point of this. Those are the years you're converting into the corridor at lower rates. A larger Social Security benefit later, plus a smaller pre-tax benefit balance later, is materially better positioned than the reverse. Deferral and conversions are the same strategy viewed from two different angles. Don't run a break-even analysis. Break-even just asks when you pass away. The real question is what happens if you don't? For Dan and Rachel, it likely makes sense to delay as long as possible. That way, once they're done optimizing for ACA subsidies, they have 5 years before Social Security kicks in to perform healthy Roth conversions and stay under the Medicare IRMA thresholds. Based on today's numbers, which would likely be a bit higher due to 10 years of inflation, they would be able to pull approximately $200,000 from their 401ks each year and stay in the 22% bracket and not pay IRMA penalties. $100,000 of that would go to what they're spending, so what they want to spend it on for whatever reason, their fixed expenses are obviously part of that bucket, but the rest is discretionary. And the remainder, or the other $100,000, would go to the Roth IRA. And then they would finally pay any taxes that they owed from cash or their brokerage account before hitting $218,000 of modified adjusted gross income, because then they're going to be able to bypass any additional IRMA surcharges and stay within the 22% tax bracket, which if they play their cards right, should be where they end up. And it's significantly better than where we're pegging them to end up if they do absolutely nothing. So let's share the screen one more time to see what their 401k balances would look like at age 75 when RMDs begin. Ideally, we want this number to not fill up as much of the 24% tax bracket that it did in the time bomb calculator, but I have a feeling they have a chance to stay in the 22% bracket for life. Let's go to the screen share and find out where they ended up.
So our couple here, if they're going to maximize for ACA subsidies, they want to keep their modified adjusted gross income as low as possible. So we'll see here at the very top, in order to do that, they're going to want to prioritize in this instance pulling from their brokerage account. And again, this isn't what the recommendation would be. This is just saying, hey, we're going to maximize for the current ACA subsidies, keep those as low as possible. So we tap into that brokerage account first. Remember, in the brokerage account, there's $550,000 worth of basis and $250,000 worth of gains. Our couple's spending needs is $100,000. And the 400% ACA subsidy cliff for a two-person household is $84,600, meaning if they go $1 above that, they will have no ACA subsidies by the government and will have to front the full cost of that. And for somebody who is a married couple, so a household of two who needs to buy ACA marketplace coverage, that's about $1,800 a month if they were to have no ACA subsidies, and that's the average case. So in order to meet this $100,000 spending need, they're going to realize some gains, and those gains are what's going to trickle down to modified adjusted gross income. So the gain ratio, meaning what they sell, is roughly 31.25%. So after you factor in some growth and assign this gain ratio to the $100,000 that they're withdrawing, they're going to have roughly $34,500 of modified adjusted gross income generated in this instance. That's significantly below the $84,600 that they can go up to still qualify for the some ACA subsidies. So they have about $50,000 worth of cliff headroom here.
In fact, they could withdraw as much as $245,000 this year and still stay below this cliff. Not that they would want to do that in this instance, but that's what they could do. So they're basically taking out $100,000. You're getting about $34,500 worth of income generated on the return. That would be federally tax-free for them in this instance, but where this will impact them is with their ACA subsidies. So if we go down, the other thing that I want to look at is if you're a little bit more graphical. Basically, they're in this green zone. So they have tons of room. They're well within the $84,600 number, and we don't have to worry so much about them approaching the ACA subsidy cliff. In fact, if we ran this out for the next 10, 11 years, the brokerage account would be gone by year 11. And they would still, they would be entering that caution zone here, probably somewhere around year 7, year 8, they go above $50,000, but they're really not in any danger of having to hit the ACA subsidy cliff. So what does this mean for our couple? How much will they have to pay for healthcare? So I want you to keep this $34,500 in the back of your mind, and then we're going to blow this up so you guys can see this a little bit easier. So what we want to do is we want to look at the number of people in the household in this table. So there's 2 people in this household, and then we want to compare this to where they fall in the income table. So for a household of 2 who earns $34,500 of modified adjusted gross income, and again, that's what we got from their capital gains realization to meet their spending needs, they would be above the 150% poverty level limit of $31,725, but they would be below the 200% federal poverty limit, so $42,300. So that means we want to look at this number and we want to go to this table right below and say, okay, if you're the 150% of the federal poverty level, you have to pay 4.19% of your annual household income, which in this instance is just their modified adjusted gross income, towards your healthcare premiums for the year. So for our couple in this instance, they would take the $34,524, multiply it by 4.19%, and they would have to pay roughly $1,500 a year for ACA marketplace, and the government subsidies would pick up the rest. And again, so in this instance, a silver plan on average is about $1,800 a month. I'm basing that off of, where I live here in Pittsburgh. It might be different if you're in California or Florida or somewhere else, but just for sake of, where I'm located, it's about $1,800 for the couple in this age bracket and where they live. And they're only paying of that about a little over $100 a month. So the government's effectively subsidizing, $1,700 for them, give or take a few bucks either way, because I am rounding here. So pretty low expenses for the ACA subsidies. We know federally they're not taxed on any of this money because their taxable income level is below the 0% capital gains. They've realized no income here. So they're in pretty good shape. They'd also, in the real world, you'd want to factor in dividends and capital gain, or dividends on top of your capital gains and any interest you earn. But for sake of simplicity, we're just looking at what they pull out of the portfolio and assuming that, there's no dividends or anything on it. So these are some other factors you want to have in there. But for all intents and purposes, this is a pretty low taxable year for them. They're not paying a ton. In fact, there's no federal tax. If they were here in PA, they'd pay 3% on the $35,000 worth of gains that they realize. So roughly, $1,000, $1,100 for that, and then $1,500 for ACA subsidies. So it's very low. But the comparison is, if we do nothing, we know that eventually they're going to get the 24% bracket. Very soon thereafter, they're going to hit the 32% tax bracket once RMDs start. And then ultimately, they'll probably end up in the 35% bracket by the time they reach their early 80s. And that doesn't factor in the widow's penalty and things like that as well. So the comparison isn't so much pay the least now, it's pay the least in lifetime taxes. So I think a better way to do this would be how we would restructure it. And we're going to go through how we can restructure this, keep them below the ACA subsidies, but keep them basically pegged to that 22% tax bracket for the rest of their life. So that's what we're going to switch to next.
All right, so now we're moving on to the last decision 6, and that's retiring to something. And I saved this for last because it's the only one that actually decides whether any of this worked. Retirement research has documented the same arc for decades. There's the honeymoon phase, travel, projects, the deferred list. It runs 6 to 18 months. Then there's a phase the literature calls disenchantment. And it's not a small thing. It's when the list is done,
the calendar is empty, and you discover that your job wasn't income, it was structure, identity, status, and the majority of your adult friendships. You cannot solve a random Tuesday in the third week of February with a portfolio. The people I've watched thrive in early retirement had one thing in common, and it wasn't the account balance. They retired to a defined thing, not "I'll figure it out." A business they'd wanted to start, a board seat, a nonprofit they run rather than donate to, coaching, teaching, a sport they compete in seriously. The ones who struggled retired from something, from the commute, from a bad job, from office politics, which is a completely valid reason to leave and a completely insufficient one to arrive at early retirement with. And this isn't a soft topic, it's a financial one. Going back to work at 57 after 18 months out is not neutral. You typically return to lower compensation, worse benefits, and less leverage. You've burned 18 months of corridor years, you've blown up whatever ACA planning you've built, and you spent down assets during the exact window when you needed them growing. 3 tests before you resign. Describe your Tuesday, not your first month. A random Tuesday in the third week of some month years out. Hour by hour. If you can't, you're not ready. That's not a judgment, it's a diagnostic. Take a trial run. 4 to 6 consecutive weeks off. Take that sabbatical and take them genuinely off. Your phone's off. You're with your family. Work can't get you. Most people have never spent more than 2 weeks away from their work in their entire adult life and are making a permanent decision based on zero data. You also want to build 3 commitments where other people notice if you don't show up. External accountability is huge, and it replaces the structure a job provides. A gym membership is not a commitment. A team that you go golfing with every week is. And do this as a couple, out loud, before you give notice. One of the most common failures I see among people retiring in the same household is 2 completely ideas of what retirement actually is, and it was never discussed what their picture actually looked like with their partner. So to close this out now, there's 6 decisions: spending, access, healthcare, risk management, social security, and purpose. Here's what I want you to take from this. They're not 6 separate decisions. They're one decision with 6 different levers. Your health insurance strategy determines your income ceiling. Your income ceiling determines your Roth conversion capacity. Your conversion capacity determines your tax bill in your 70s. Your Social Security timing determines how much you draw from the portfolio in the gap years. Your withdrawal rate determines how much risk you're permitted to take, and how much risk you take determines whether the whole thing survives 40 years or not. Optimize any one of them in isolation, and you're usually going to make at least one of the others worse. That's why the DIY version of this, and frankly the version most advisors deliver, tends to produce a portfolio recommendation and a Social Security break-even chart and nothing that connects the dots. If you're 50 to 59, start with that RMD time bomb calculator. The link's in the description, there's no cost, and this will help you get started. And if you want to run this on your actual numbers, there's a link below to schedule an introductory conversation with our team. Thank you so much for watching. I'm Ryan Knoll, and I'll see you in the next video.